All right, we'll give just another moment to let these few folks coming on at the last minute here. Okay, Lori, whenever you want to give me the thumbs up, I can get us started as well.
Yeah, let's go.
Okay, perfect. Well, attendees, welcome. It's a beautiful day outside after such a stretch of storms this weekend. So anybody having any internet problems, please jump on and jump off as you need to. But you're at Win-Win Charitable Giving. And if you're like me, it's a stressful time of year. There's so much going on. And this is the one time of year where we have a hard deadline coming up as it relates to the end of year giving and then tax implications for the end of year and what a lot of donors are experiencing and thinking. And as fundraisers and as donors, there's a lot at stake right now. And that's why this panel of experts that we're about to meet are going to help us through. I know I've even, as the moderator, I've got a few questions that I'm looking to get answered today as well. So if that's the case, let's get started so we can get right into our information. And you've also got the option to ask questions in the Q&A. As we go through, we will have a section for questions at the end of our session. So Alyssa, there we go. And again, my name is Mike Schmidt. I am your moderator. I am an executive vice president and partner at Kramer and Associates. I have been with the firm for a little over 25 years, actually 26 years. We've got a wide variety of nonprofit organizations that we work with, doing campaigns in a wide variety of things that we're doing a lot of different areas. And one of those things you never really feel like you know enough about is plan giving and tax estates, everything else that we're going to be talking about today. That's why I was so pleased to be able to be a part of this. Looking at David Reed is also a principal at HW & Company. David, I'm going to ask you, could you share a little about yourself, your background, and what you're bringing today?
Sure. Again, my name is David Reed. I'm a principal at HW & Company. We are a CPA firm located in Cleveland, Mansfield, and Columbus. I've been in public accounting working on a broad range of clients for close to 30 years, but out of that time, about 20 years of that, I've really spent a lot of time focusing on the nonprofit sector. Been very involved with nonprofits for many years at many levels, either with serving on boards, working with my clients, or working with the Ohio Society and the IRS on the which still seems to be recent tax form changes of Form 990, but it's starting to get a little bit long in the tooth now.
Excellent, excellent. Well, we're looking forward to your insights, especially with a lot of the tax changes that have happened recently. Your insights are going to be highly valuable. We're going to turn now to Jill Garvey from Huntington, and certainly from the Wealth Strategy section. Jill, can you share a little bit about your background?
I'd be happy to, Mike. Good afternoon, everyone. I'm very happy to be with you here today. I consider myself a problem solver. I'm very, very passionate about all aspects of financial and wealth planning, investments, tax planning, estate planning, and I'm very fortunate to be able to work with clients at Huntington and also represent us in the media. I look forward to our discussion today. Thanks, Mike.
Excellent. Thank you so much, Jill. Next up, we've got Rob Kugler, who's also from the investment sector from Huntington. Rob, can you share a little about your background? Oh, Rob, you may still be on.
Mike, I'm glad you're paying attention. Well, good afternoon, everyone. Very happy to join everyone here today. I'm a private bank investment advisor with Huntington, and I've been with the bank, let's see, it'll be my 20th anniversary coming up here this coming May. And the entire time that I've been in this business, 26 years, has really been in the area of financial planning and investment advisory, really to a whole host of clients. Everything from individuals, corporations, and certainly not-for-profits as well. So real happy to be a part of this.
Excellent. Thank you, Rob. And then we're going to go to Bob Behall with the Behall Law Group. Bob, can you share about your background?
Absolutely. Thank you, Mike. And thanks to Lori and everybody for putting this together. I'm glad to be a participant. I've been practicing in various areas of the law, but mostly business law and estate planning, probate, for, hate to make everybody else look young here, but 40 years. And got a wide variety of exposures. And of course, trying to keep up with the tax laws is something that I admire the CPAs for being able to do so well, because it's tough. But we'll see if we can help people focus on some year-end tax strategies here today.
Excellent. Perfect. Very much appreciated. Well, then let's also talk quickly from Lori Sontag, President and CEO over at the Breathing Association. Lori, you're new in your role.
Yeah, yes, September 1. So this is exciting, and we're honored to sponsor this webinar today and to bring this group of experts together for the first annual Charitable Giving Planning Strategy webinar. And the Breathing Association is a 115-year-old healthcare organization. It's a nonprofit, and we are 90% grant funded. The other 10% includes funding by donors, by generous donors. And we were founded in 1906 due to the outbreak of tuberculosis. So our mission today is still dedicated to caring for people who have respiratory care needs in the healthcare area and who also are struggling and need free care. We've been a long time provider of smoking cessation, and we now have a national online course to provide training to providers and certification. We also administer home energy assistance grant or funding for low-income families. So in honor of our 115th anniversary, the Breathing Association, over the years, our organization has received so much support from the community. So we just thought in turn, we can give back and to so many and share this time with you guys, and hopefully you get a lot out of it, just like we are going to. So thank you all for joining, and special thanks to Creative Spot for pulling all this together on our webinar today for us.
Excellent. Well, thank you, Lori. And we very much appreciate the Breathing Association hosting today and for your work in pulling us all together. With that said, let's dive into our topic today. And I know that everyone's probably just as eager as me to get to the questions. Really, we want to start out because this is the season of giving, and so much of the work we do in philanthropy does come to a big peak at this time of year. Jill, let's start with you. And what, from a donor perspective, are things going on, certainly from an economy standpoint? Are there things that you want to highlight in particular, or that you can share from insights?
Absolutely, Mike. Great question. Thanks for asking. We have a lot of things on our mind right now, and I think it's important, number one, to highlight that we feel normalization around supply, demand, and activity as it relates to the economy. That should happen sometime next year. So that's number one. There are several other trends that we're watching with respect to what's going on in the economy and the markets. And the first is the most hot topic out there, inflation. Now, we think eventually things will settle down into the 3% range, and it could be as early as next year, but we would not be surprised if that persists further. I think the word that we heard for so much, and now I'll call it persistent inflation. So that's a very hot topic. The second is monetary policy. Very important. We're watching that very closely. And we suspect at least one Fed rate increase again in the second half of next year. The third would be interest rates. Interest rates are still at historic lows. Great for borrowers, really tough for savers right now. So we're watching those interest rates to see how they're going to affect our client's balance sheet. And of course, we're looking at the asset and the liability side on the balance sheet to help clients manage those risks. The fourth would be corporate earnings. We feel that corporate earnings should continue to do very, very well into 2022. That's another reason why we have a bias towards equities. And then the fifth would be imports and exports. Again, as we see economies open up, there's a lot of opportunity out there with tourism. And again, we should see supply chains normalize. So those were a few things I wanted to highlight. Another item would be cash. Cash has an unusually high cost right now with interest rates being so low and inflation running hot. So if you do have a lot of cash on your personal balance sheet, consider what you might want to do with that. An idea would be, if you aren't going to invest it in the market, we do have an enhanced charitable contribution for contributions to charitable organizations of cash only. And you could essentially zero out your adjusted gross income this year, up to 100% of your AGI in cash donations directly to charitable organizations. That does not apply to donor funds. So Mike, I think that's a really interesting idea. But my thoughts, and go back to inflation, I think it's very important that you're working with your financial advisor, if you have one, and talking about how they are positioning your portfolio to hedge against inflation. Some things that we're looking at that have worked very well for our clients would be investing in small caps, global real estate investment trusts. Again, we like that for income and the underlying appreciation, treasury inflation protected securities, and some precious metals. So if you haven't met with your investment, you should do so and consider the effects of inflation on your portfolio. Mike, I'll pause and see if there's another question, or perhaps
absolutely,
my colleague Rob would like to add in.
Well, and I was going to ask Jill, I know so many of the issues that you touched on with inflation, I always think of them as global issues, but clearly that's impacting locally as well. That's not just a thing for the news, but that's actually the companies and the businesses and the investors here in our local economy are dealing with all of these things, correct?
Absolutely. We at Huntington Private Bank, we represent a number of business owners, and they're concerned about the prices of the goods that they buy and the supplies and how delivering ultimately to their customer, in addition to how it's affecting their personal balance sheet. So yes, I think we've all seen the painful effects of inflation, certainly at the gas pump, but there are ways to mitigate those effects long-term in your investment portfolio.
For sure. And David, I'm going to ask you, I know Jill touched on cash donations. As it relates to itemization, is there anything that people should consider about how they can itemize?
Yeah, so new for this year, actually a repeat from last year, but as part of all of the CARES Acts and other tax legislation that has gone on in the past 18 months, there's a provision that allows you to take what we refer to as an above the line deduction, meaning if you don't itemize and you take the standard deduction, which has been elevated since 2017, for this year, you can still get a $300 above the line deduction for single taxpayers, $600 for married filing joint, And, really the only stipulation is that donation needs to be in cash to a public charity. So, you can't do that to a donor advised fund, which we'll talk about in a minute, but it has to be another public charity like the Breathing Association. And then the other thing to kind of keep in the back of your mind, which is constantly on the fore of my mind, is the Build Back Better bill. That seems like it's been going on in Congress forever. We were very concerned about it in the summer. As time has gone on, the provisions that we were most troubled by seem to have fallen out. So at this point, we're not expecting huge changes out of the bill from a tax policy standpoint. But as Congress is prone to do, though, it's very possible they could be throwing us a curveball at the 11th and a half hour once the bill actually gets voted on.
Well, and that's a great point, David. I think as folks think about and some of the things that Jill touched on with interest rates, what some of the bigger with inflation and with Build Back Better, what are ways in which either a donor or a fundraiser might be watching for that? Where, other than just the general news, are there different spaces that we could look to see how that might be impacted or what that might mean for us?
It really depends on what ends up being in the bill. Early on, we were very concerned about individual tax rates going up across the board, which would have suggested maybe holding off donations until 22, try to accelerate a little income into 21, pay tax presumably at a lower rate than 22. Since those provisions seem to have fallen out of the bill, now I think it's really more of a decision of what's best for myself and what's best for the charity that I want to support, looking at, the timing of those donations between 21 and 22.
Okay, excellent. And then I think, Bob, I know from a planning perspective, anything that Jill touched on that you want to hit?
No, I think I'll hit some points and refer back to what she said when I get to the third question. I think we're okay.
Perfect. Because I know just especially from the timing and then the short-term and long-term strategies. I think we're going to touch on that in just a little bit.
Right.
Rob, I'm going to let you have the last note on this question then. Anything else from the Huntington perspective that you're thinking of?
Well, I think, and Jill touched on this already, but I think it's certainly well worth reemphasizing, particularly this time of year, to be engaging with your advisors, whether it's your CPA or your financial advisor, to look at, your current tax situation. And if there are any strategies that can be taken prior to year end to, lessen the tax bite. So I certainly think that's something that should be top of mind for everyone, whether it's, tax loss harvesting would be a thought that comes to mind, assuming that, portfolios have such losses to take, given that we've benefited, frankly, from a very robust market.
Yes.
And so many times tax losses are few and far between. But as we kind of go through, I think there's going to be some other strategies that are going to be discussed that would be very valuable still here before year end.
Excellent. Well, that's a good segue to our next question. If I can get us to.
Yep, I think you're on the right screen, right?
There we go. So I think if I'm correct, let me go back one. Here we go.
Yeah.
There's so many tools out there, and I think especially from either a donor or a fundraising perspective, as we're having conversations about charitable giving this time of year, and there's only 18 days remaining in this year, what are some strategies and some of the tools that we may want to think about? David, can you give us insights on what are those and how people should be thinking about them?
So listed on the screen for you are a number of tax terms, and let's kind of go through those one by one and define those. The first is a donor advised fund, and how that works mechanically is it's basically like setting up almost like a brokerage account where you make a charitable donation into that account, and the account would be held at Columbus Foundation, Cleveland Foundation, Fidelity has an account. A number of other organizations have these donor advised funds, and basically what you do is you make a donation into it, and then over time, as the advisor, you have advisory rights and suggestions where you can tell, okay, Columbus Foundation, I'd like you to send money out of my donor advised fund to the Breathing Association. Where this has come into a little more favor recently has to do with tax law. I mentioned on the increase in the standard deduction, what we found is a lot of our clients weren't itemizing anymore. They were taking the standard deduction, so they weren't getting the full benefit of their charitable donation. So what the planning is the concept of bunching, where, given the cash ability, a donor would make, 3, 4, 5 years worth of donation into a donor advised fund, get a substantial tax deduction in that year, and then that donor advised fund would trickle out the money over that same period of time to the charity of choice. So it becomes a very nice tax planning tool. One of the provisions, though, is that you don't have a lot of control. It is a donor advised fund. It presumably the fund holder does not have to follow your instructions. The next one is IRA qualified charitable distributions.
David, I'm gonna ask you real quick. I'm sorry to interrupt. How long can that be done this year? Then it doesn't take long to establish one.
No. The donor advised fund is like I mentioned, a lot like a brokerage account. Takes a couple of days to set up, to create the account and get everything going. But there's certainly still enough time to get that done this year.
Excellent.
The second one I was mentioned, IRA qualified charitable distributions. It's a little more technical, a little narrower, but basically if your donor is 70 and a half, has money in an IRA, they can direct the IRA to send money directly out of your IRA account to your public charity of choice. Couple of advantages to that. If you're 70 and a half, you have to do what's called required minimum distribution. You have to take a certain amount of money out of the account every year. This qualified charitable distribution, or QCD, counts against that required minimum distribution, so that your required minimum distribution is actually reduced for tax purposes by that. The nice thing is like I said, it's an above the line tax deduction, so that's very nice. And you kind of get a little bit of a deduction on the backside with a decrease in your state income as well. The only limitation is, like I said, you have to be 70 and a half. You can do up to $100,000 a year out of this to charity. Have found that even clients with modest income, where they, every year give $500 or $1,000 to their, favorite charity or religious organization, they have started doing this as well. Every little bit helps as far as redirecting the money off of your tax return and reducing your tax bite. Stock donations continues to be a real popular option. This is basically where, if you've got some long-term appreciated stock, so stock you've held for more than a year and that you have a gain on, give that stock directly to the charity. Again, it takes a couple of days to transfer. You need to contact your broker and and put them in touch with the broker of your charity. But it is a nice benefit, because what happens is, if I have, for example, a stock that's doing really, really well, I have a big gain on it. If I would cash in the stock, I'd recognize the gain and then pay the cash over, get a deduction for it. But if I do the stock directly, I just get the deduction. So it's really definitely a win-win. As a donor, I get a nice benefit, and then the charity still gets the full value of the stock donation. And then the last two on that list are charitable trusts and foundations.
Mhm.
These are more complex. tax strategies. You could do some very creative things with trusts and private foundations. But at this point, it's too late really to take advantage of these. But these are things to think about for 22, where you'd want to get a hold of your tax advisor, your attorney, to really craft these documents to make sure that they work out best for you. Again, there's some very powerful tools to do some very creative things in the gifting space, but it's not something that you can flip a switch and do very quickly.
Okay, excellent. Well, especially from the tactics standpoint, I know these are amazing tools. Jill, I'm going to refer back to what you were sharing earlier. Anything about what David just shared that might be relevant based on what you were sharing earlier on the investment perspective?
Great job, David, touching on all of those wonderful charitable giving techniques. I think it's very important, Mike, for our audience to understand that there can't be enough emphasis on collaborating with your tax advisor who can show you the different numerical effects. How might your tax liability change if you institute one of these techniques, or even combine a few. Number one, engage your CPA early and often. I say that as a recovering CPA who no longer practices in public accounting. And number two, I think collaboration among advisors when you're looking at the big picture of your financial situation. We don't want to look at it in a vacuum. We want to look at it on a multi-year basis. Engaging your financial advisor, your CPA, and your attorney to collaborate together on your behalf makes a lot.
Excellent. That's good insights. Bob and Rob, anything that I'm not asking that I'm not aware to ask that we may have left out?
I think that's a great job. One thing I might note, in case you didn't see it, Mike, it does look like Lori has a question, so I don't want to let that go unnoticed.
Lori, perfect. Can you hear me, Lori? What would you like to add to that?
Yeah, well, I don't have a thing to add. I have a question of this panel. Is donor advised funds. Recently, I read there are billions out there in these funds that have not been distributed. And as a nonprofit, I'm wondering, how do we get in front of those donors so they learn about the different charities and all the things they're doing? And it's my understanding those funds can be there for a long, long time. They don't have to be distributed. So I don't know, eventually, do they go into an estate, or they're once you've given them, they stay with that Fidelity or Schwab or whoever they go with forever, right? Until they're distributed.
Right,
If
right.
the donor is no longer there, then their estate would make that decision for them. How does that work?
Yeah, the money is no longer yours. You've made a completed gift. You've transferred the money over to, the foundation or the Fidelity. So it's no longer your money. So it's not included in your estate or anything. But the thing that I've suggested to a number of my nonprofit clients is as you're having conversations with your donors, just ask them, do you have a donor advised fund? And you'll be surprised to find a lot of times the response is, oh yeah, I think I set one of those up 3 or 4 years ago. So again, it's an effective tax planning tool. But sometimes people leave it at that and then kind of forget about it. So just kind of, gently prodding them to see if they even have an account may be part of, of the process of getting some money out of those donor advised funds.
So those gifts, if I'm a donor and I have $100,000 and put it in a donor advised fund, then is 100% of that tax deductible? Or
yeah, when you make that gift, it's a completed gift. So
okay.
you get a whole $100,000.
Right
There's
when
no
you give it, right?
Right.
Okay.
Excellent.
And David, you could also comment, this is Bobby Hall, that asset no longer is part of your gross federal taxable estate from a federal estate tax perspective either. Right?
Correct. Yeah. Once you've made that completed gift, it's not your money. so it's not in your state. You don't have to worry about picking up income on, even though a lot of times the statements you'll get looks like a brokerage account and will actually tell you how the account is performing. It's not your money. So you don't have to do anything with any earnings on that account. Your job at that point is to admire how much it's growing, but then to remember, oh yeah, I should make a donation out of that account before the end of the year to my favorite charity.
So even the income she's using $100,000 example, you as long as you're I guess you have to be below your AGI is a limit. The 100,000 is a limit for sure, right? But the income that $100,000 generates, let's say it generates $3,000 in interest, that income is no longer on your 1040 either, is it? The $3,000.
Correct. He's like I said, it's not your money, so you don't have to worry about it anymore.
Right.
Yes, as often, many of the community foundations are quick to point out as well when they set up donor advised funds. That is part of it. The blessing is that it's no longer your burden, but the challenge also is folks still want to have that sense of ownership. So that is a good informational part to consider. Well, all right, on that, I want to make sure we have plenty of time for questions and answers at the end. I'll go to the next question. We always think of cash this time of year, especially as folks are making those last minute donations. But there's a bigger strategy here. And I think this is where we're really looking, Bob, from that, both the longer term strategy and then also increased tax implications. What are things that you might be able to share from an estate planning perspective, addressing this win-win for donors and charities?
Right, exactly. I think of course, writing the check, like you say, is easy and first thing that comes to mind. But something that's very valuable is the concept of giving assets that have appreciated significantly since you purchased them. For instance, the easy one is publicly traded stocks, where you might buy $20,000 of a large publicly traded company, let's say, or a small one, doesn't matter. And the stock has gone up over the years that you've owned it. And some people, you hold stock for decades because you're in the buy and wait and just, you're not an active trader, but you're just sort of riding the market. And that stock becomes worth 50,000, right? So eventually what has to happen is you sell the stock or you pass away, of course, which is another possibility. And then there's a stepped up basis, but assuming that you're still alive and you sell it, and then the $30,000 difference between your $20,000 investment and the $50,000 value would go to David and his boys and girls who do their 1040s, and there'd be some capital gain impact on that. And even that number is up in the air as to what it's going to be next year, or for that matter, 5 years from now, who knows? But there's definitely going to be some tax on the gain that you derive. So a nice little non-cash item would be to take that $50,000 in stock and give it to a charity, right? And that transaction is valued for charitable deductions at the level of the value of the stock. Now, publicly traded stock is easy to value because you could just look it up on the New York Stock Exchange or NASDAQ and see what the value is on the date of the transfer. And you made a valuable transfer to the charity because they get the full $50,000 of value. You also write it off at the $50,000 level, but you really only got $20,000 invested in it, and you avoid the $30,000 of capital gain, which would could generate $6,000 of tax liability for you. Right? So that's one very sensible and valuable trick of the trade that's not cash. Now, there are other assets that you can also gift. Cars are sort of famous. There's a lot of commercials on TV, charities that like to get your used cars. You can give real estate or homes. If you give something that has, you can always appraise whatever it is that you're giving, no matter what the value is. But if you're going to write off more than $5,000 for a value, then I think you pretty much have to have an appraisal by somebody who's a qualified appraiser in that field. And that might be somebody who knows artwork, if you're going to donate artwork, as opposed to somebody who would be a real estate expert who could value a rental home. Maybe you want it to unload and give to a charity. Of course, the charities don't have to accept every gift, because there are, Ohio State is kind of famous for not accepting certain real estate that might have some environmental difficulties associated with it. And there are other examples that are famously in the newspapers when gifts have a little too much baggage associated with them. But nonetheless, that's something you just have to work through with each donee charity and work it out. But the donor is responsible for asserting and proving the value of the gift at a time that the gift is given. So sometimes you have an old valuation on a piece of real estate. Probably the IRS is going to want to see that you've done a more recent valuation contemporaneous with the transfer or the gifting. And that's something you should take into consideration. People also give time, and this is something that maybe David could speak on a little bit more technically than I could, but we're lawyers are amateur accountants, and but we know a lot about it because we deal with a lot of accountants, but we can't be an accountant, nor do I feel like I'm qualified to do so. But nonetheless, time is not a deductible contribution, as I understand it. Now, there are some more tangible things that you can help out with. I think you can take gas mileage, or if you use your vehicle to help a charity, there are certain things you can do, but you probably should get with your tax advisor before you start getting any big ideas about what might be tax deductible. Most of the donor advised funds, the brokerages or the foundations that will handle them, are pretty up to date on the best way to handle any kind of a transfer of that nature. So if you have a donor advised fund, you could always go to that fund and ask them for some advice as to what might or might not be the right way to deduct these things. The question came up in a discussion as to whether cryptocurrencies are donatable, and I've got to think that they absolutely are, but you probably need to get them appraised. They're not going to go dollar for dollar like a cash contribution is, or stock in AT&T, something that's easily ascertainable and valued. So those are some of the ways that you can give money in a more creative and a non-cash fashion. And some of them, especially appreciated assets, is a really excellent technique for both the donor and the charity.
One question I've got really quick, and Rob, this is where, and Bob, I'm sorry, where I'm thinking in terms of families as they're making these plans, as you've got parents and generations together, when they come to you to speak to this, what is your advice on who should be in the meeting?
Well, attorneys have a different situation than accountants do, and in the sense that if they talk to you about something, there's an attorney-client privilege that the client has. If there's somebody else with them in the room, then that privilege is gone. So now you got to be a little bit careful what you're saying. You need to advise the clients that the privilege is no longer available to them. And what we would probably do is tell them to talk to an accountant. And then you can bring your whole family in and probably even get a little bit better in terms of technical advice as to whose tax return, how does it benefit people, right? Sure. Because you can also gift to your relatives, right? Now, a lot of people, of course, gift to their relatives to diminish their gross federal taxable estates for federal state tax purposes. And then sometimes it's the next generation that would make the gift. Maybe the next generation is earning more income right now, so that the older generation is more interested in diminishing their gross federal taxable estate because they don't have as much income. Whereas the 80-year-old gives to the 55-year-old who's at the peak income level, and the 55-year-old makes the charitable donation and gets the benefit of some of the double whammy of income tax deduction, as well as, of course, there's a diminishment of the gross federal taxable estate for the 55-year-old as well. But David, once again, I defer to you to help clean up the mess that I just created there.
Yeah, so a couple of things, you touched on the value of volunteering, for an exempt organization, that's really priceless, as far as valuing goes. But as the volunteer, it was already mentioned that you do get the charitable miles, 14 cents a mile, plus anything that you're out of pocket on for. So for example, if some reason you have to pay for something as part of performing that work for the charity, basically what you need to do at the end of the year is go back to the charity, say, hey, I spent $120 doing this event for you. Please substantiate, for my accountant that, I participated in this and here's my receipt, so you can take that as a charitable deduction as out of pocket. The other thing you mentioned was the cryptocurrencies. Even though currency's in the name, it's not treated as a currency. IRS has taken the position that it's really treated more like property, as if it was a piece of artwork. So be careful with donations of crypto. It's very tricky. As mentioned, if you're going to donate more than $5,000, you do need a valuation for it, even though it should be fairly easy to figure out what the value is, but IRS has a long history of, if you don't dot the I's and cross the T's when it comes to donations of property and their valuation, they just deny the whole thing. So even though you made a donation, the IRS will just say, since you didn't follow our procedures, it didn't happen. So
and
it's very
David, we did have a question from Scott Solomon, who is
Sure.
Head of the development team over at the Childhood League Center that does such a great job. His question is, I'm seeing more and more discussions on social media on the topic of accepting NFTs such as Bitcoin as a charitable donation. Have any of you had clients who have wanted to donate an NFT to a nonprofit? And if so, can you share how the process might differ from the donation of other appreciated assets? And you were going there, David, so that's why I wanted to see if you could refine your answer to addressing that a little bit more succinctly.
Yeah, no. So I think you're kind of almost answered the question yourself. You treat it as if, they were donating a piece of art or something like that, or wanting to make sure that they're going through the proper steps. You should not, as the charitable organization, you are not required to provide a valuation, but it wouldn't hurt to remind them that they do need to get a valuation done. There's a form 8283 that needs to be filled out and signed by both parties to acknowledge receipt of the property. But for right now, cryptos and other NFTs are treated no different than, the painting behind Jill right now. You have to go through all of those same steps to validate the value of that. And if the donation is for $5,000 or more, a formal appraisal does need to be done. So it's challenging right now, but until IRS recognizes crypto and NFTs as closer to currencies rather than property, we're kind of stuck in this position for the time being. And as the charity, you should be looking at what your gift acceptance policy is. There is costs associated with accepting those types of things. So even though it's difficult, it may behoove you to say no at some point. I've had nonprofit clients in the past where they've accepted some unusual gifts, and then they're kind of stuck with it. And it's left to their development team to figure out, how do we monetize this gift? The donor said it was worth X. The people we want to sell it to is telling us it's Y, which is substantially less than X. What do we do? So definitely look at what the charity's gift acceptance policy is to make sure it's a transaction that the charity wants to enter into.
And David, just to remind me, the legal burden is on the donor when they're doing their taxes, not on the charitable organization.
Absolutely.
To the
The charitable organization needs to acknowledge receipt of the gift, but they should acknowledge that they received it by describing it. They should not be putting any kind of valuation on what it is. Just state, it was a house at this address, this year, make and model car, this piece of art, etc. But should not be associating any kind of monetary value with any of those acknowledgments.
Excellent. Well, as we come up to the last, our period of the last 10 minutes of our time frame, I wanted to leave it open for a lot of questions, and I know I've got a few. I'm going to start with Jill. We heard some short-term and some long-term strategies. You highlighted things that brought my anxiety level a little bit up, talking about what 2022 is looking at. Anything that, as you heard from that you might want to think about, just to round that out from what you were sharing, to the short and long term?
Sure, absolutely. Short term, I think that at least at a minimum, as an individual investor, you should be reviewing all of your assets, not just your investment accounts, but all of your assets, your entire balance sheet. Every 3 years, or when you've had a major life transition, I think you should be updating your estate plan. So that would be a more intermediate term recommendation, and proactively doing tax planning with your CPA. But a few other items, if I may, that are a little bit outside the charitable giving confines. Please make sure that you've contributed to your retirement plans this year. You've made maximum contributions. Look at your ability to do any other types of retirement plan contributions, such as IRA contributions, backdoor Roths, a Roth conversion, and again, make sure that you're withheld appropriately prior to the end of the year, 110% of last year's tax liability or 90% of your estimated liability for this year, and have a written financial plan. Execute that with your advisor if you have not already done so.
Okay. And Rob, I've got a quick question that maybe you can help me with too. If you're looking at from a donor perspective, and your family around the Christmas or the holiday period is considering saying, let's do something, where do I start? Do I start with from a tax perspective? Do I start with more of an attorney perspective, my local banker? What's the process for timing on who we start these conversations with? Is it all of the above?
Well, that's easy, Mike, because since I'm a financial advisor, I'm gonna tell clients they need to start with their financial advisor. No, I think that in honesty, that whether it's a family's financial advisor or advisors, their CPA or their estate planning attorney, that I think any of those individuals would be more than qualified to start that conversation. Whether it's about just big picture strategies and how to accomplish a desired giving program, or if it's specific. So somewhat tongue in cheek, I think it's great to start with your financial advisor, but again, to the extent that individuals have all three, I think any one of them would be very well suited to answer those questions and help with that process.
Excellent. And Bob, I'm going to turn to you real fast. Relative to, you often have meetings like that with other teams involved. What is your process as it relates to someone coming with a question or having a thought?
Well, I would say that most of the time we meet individually with the client or the client and their spouse. That's generally what we see. And then as questions develop, usually their accountant, for instance, is very familiar with their tax return for the last 4, 5, 6 years. And it's good to have that historical knowledge of how have they been making money? What are their, do they own their own business? What kind of depreciation schedules do they have? what brackets are they in, and how are those brackets going to be affected? If you can give make a donation to a donor advised fund and knock yourself out of the top bracket into a lower bracket, that's a good thing. It even affects how much you pay for Medicare and your IRMA for those numbers. Now, those are not large numbers, but they're a couple $100 a month. They can be a couple $100 a month. So I would say that most of the time what happens is we'll say, let's call your accountant maybe, and let's have a conversation with your accountant and or financial advisor to see what kind of investments you're involved in currently. So most of the time it's listen, learn, try to be a problem solver, as Jill earlier mentioned. And if you get to an area where you think it would be helpful to have the person who's doing their tax returns voice an opinion, that's the time to bring them in. And so that's generally the way I find that it occurs.
Well, and Bob, I've got a follow up on that. Something you hit so many times. A donor will say to a nonprofit, I'm going to be leaving something in my estate plan. And often the nonprofit's the last one to know and to find out until things are actualized. Is there anything that a nonprofit or a development professional can do when a donor says that? Should they say, we'd love to be a part of that discussion? How do they interact with that dialogue?
Well, you know, we've had a couple situations where somebody put something in their will in 1962, and that charity has changed their name or has gone to, a different way, or even in some cases terminated their existence. And here the probate court is stuck with a devise of cash that is to an organization that's not clear. It's not precisely an organization that exists currently. So the answer to that question is, I think one of the things I think that Lori mentioned earlier that was pertinent and important that you're bringing up again, and that is, it's important for the charities, I think, to be, at least in some clever way, informing people that are regular donors that there are some things you need to keep thinking about as you go through life, because we all know how this goes. You do a will, you think you've done your will and trust, and then you blink and 12 years has gone by, and now your kids are 40 instead of 22, and or whatever the age limit is that you want to restrict funds for, and that's gone. So you need to revamp your will and trust. And I think telling your donors, hey, if you do revamp your will and trust, don't forget us, and don't forget that there are some good techniques that you can use that we're glad to help you with. But the name of our group is such and thus. People think they know the names of charities, but they don't always know the real name. And you should be helping them know your real name so that it's clear to the probate court, let's just say, as to who the donee is supposed to be. Right. Perfect. That's an interesting question.
And David, I want to turn to you. I know so much of what we talked about is the timing of the holidays and end of tax year. I know to the advice that you might give is to start sooner rather than later, but what is that time frame coming into this last stretch? Any advice you would give to folks?
Yeah, like you touched on, do it now. Let's don't wait until you're on your way out for the New Year's Eve celebration. Because so many of the things that we talked about do take a couple of days lead time to put into motion. So in the next couple of weeks, start having those conversations. If you want to set up new donor advised fund or something like that, get the paperwork rolling. If you want to do a stock donation, as Jill mentioned, the markets are up. Now is a great time to look at your portfolio and maybe move some of those real big winners to your favorite charity. Put those things in motion this week rather than waiting for the week between Christmas and New Year's, since everybody seems to be off that week, and it's tough to get a lot of that paperwork done and at that last week of the year.
Excellent. Well, unless we have any other questions, I'm trying to be conscious of time a little bit. Rob, I'm going to ask you anything else that you want to before I turn to Jill.
The only thing, and this might be a little bit beyond the scope for today. We talked, a fair amount about things that can be done between now and the end of the year. There are certainly, lots of other strategies that are available from a giving perspective. And I don't know, I would look to, certainly one of our either tax or legal experts. But I know that there are other strategies that can be considered longer term as longer term planning strategies for giving. So I want to keep that in mind, and to the extent that we might have any time, if Jill, David, or Bob has any comments about longer term giving strategies, I think that's something noteworthy.
Excellent. Yeah, and I think, Jill, on that note, can you bring us home?
Sure, absolutely. We may need to have another webinar to talk about those longer term strategies. So thanks, Rob. That's a perfect setup for another one. A lot of our clients, charitable remainder trusts that are longer term trusts that pay an income stream back to the donor, and then at the end of the term or the end of the donor's lives, a charity or charities can benefit from the remaining asset. There are certain rules you have to follow, but that's one longer term strategy that we really like to employ with our clients. We like to fund it with appreciated securities, publicly traded securities. You have to be very careful if you're putting other types of assets in there, but that's something that we really like. And again, in collaboration with your financial advisor, your CPA, and your attorney, you can really make that be a very beneficial technique to you and your family. So I'll turn it back over to you, Mike. I appreciate everyone's time and attention and the opportunity to be with you.
Perfect. Thank you, Jill. Lori, I'm gonna, before I turn it to you to close us out, I do want to thank all of our attendees and especially our panelists. The expertise you brought today was so timely and vitally important. So thank you for bringing us together, Lori. I'm going to let you close us out today.
Yeah. I thank everybody for participating and their questions. This was very helpful. I took a lot of notes and this is good. I mean, I've been around fundraising and nonprofits for a long time, and it changes all the time. So it's hard to stay in front of all the things that are changing and all the options that are out there. As a nonprofit, we have our web page and there's a donate button. But the first thing I did when I started in September was go look at that to see, is it up to date? I think that's something, if there's other nonprofits, just to make sure that donate area is up to date and the links work. So if you have donors giving that way, that it actually executes. So, but thanks everybody for your time. And I'm sure we'll have a number 2 coming up, number 2 webinar sometime.
Excellent. Thank you very much. And everyone have a great holiday season.
Great. Thank you.
Thank you.
Thank you.
Thank you.